most of the narrative that we're hearing in the financial press is stocks are very expensive because they're up so much. And I'm like, no, stocks are cheaper because the earnings are going up less than the prices.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to this episode of The Bull of Wall Street. My name's Talley. I'm the Chief Market Strategist at the Wealth Consulting Group, and I'm joined by my co-host, Jim Worden, our CIO. And our guest this time needs no introduction. None other than Jonathan Golub, Chief Equity Strategist at Seaport Research Partners. Welcome to the show, Jonathan.
Thank you, Talley. Great to be here. Hi, Jim.
How you doing, Jonathan?
Good.
Well, so I have to tell the story. We go back a ways, Jonathan. First of all, I mean, you've been everywhere, right? You've been the strategist at UBS and Credit Suisse and RBC. And in fact, I remember coming through your office when you were at RBC, but this has got to be 10, 15 years ago. And we were exploring ways of working together. At the time, I was running my own little independent macro research shop. So it's interesting. We've been having all these guests on. The tables have turned, and now you're doing your own thing at Seaport.
Yeah, I mean, I matter of fact, I started this thing on the asset management side of the business as the chief strategist for JP Morgan Asset Management. And we created this little thing called the Guide to the Markets, which was ended up becoming, widely followed in the industry. But as you guys know, when you change the audience you speak to, the whole way that you view markets and communicate on them changes. And early on, we were working with financial advisors and that high net worth market. And today my clients are, some of it is the RIA community, but a lot of it is larger institutions, hedge funds, pension plans, money managers. So it has a different vibe to it than when we first met.
Well, so I wanted to ask you, so what is your edge? What is your advantage now at Seaport that gives you kind of a tangible leg up or step ahead compared to some of those other bulge bracket firms that we've all worked at?
Yeah, so, and Talley, you and I were talking about this, I think it was yesterday, when you're working, let's say as a registered investment advisor or a money manager, for the most part, you're taking information which is readily available, and your job is to create a mosaic or framework that makes sense for your clients.
Right.
When you're working on the sell side, which is where I am now, and guys like you are my clients or the advisor community, I don't have the benefit of other people's insights. I'm when people say, "Oh, you must read a ton," in reality, we look at just an insane amount of data, and we create these building blocks. And it's your job to say, "That's really nice, John, but I've heard the opposing argument from others," or "Here's something else." And our job is to basically try to be edgy and to give you the tools or the pieces to make better decisions. So what's the edge? The only way to do this job, the one that I do, which is a little bit different than yours, is to just build really sophisticated infrastructure to be able to cull through an almost never-ending amount of information and to put it into a usable framework. And that's what we do. And I've been doing this now for 25 years.
Wow.
Well, so that that resonates and well said. And what I've always appreciated about you were talking about the guide to the market. I mean, I've always had a chart book myself, but you're also similarly very visual. You're a chartist like me and Jim too. So this can be easy conversation. But as I've seen you kind of evolve and move, transition throughout your career, I think the way you started with the guide, it was good at telling us about the past, and you've changed. Like now you've gotten much better, I think, at current conditions, but also describing where the puck may be heading. And of course, that's our favorite Gretzky quote. And this is one, I want to get Jim into the mix here too, but tell us about that infrastructure and how are you leveraging AI? Because we're doing some of the same things too, but I want to give you the microphone first.
Okay, so first of all, we are not fans of having AI do the analysis. If you ask AI the same question and ask it, so if you, for example, say to AI, I'm really bearish, tell me about earnings season. And then you ask it again, I'm really bullish, tell me about earnings season. It literally will give you the data will be different. The numbers will be different. It makes stuff, or it takes liberties. And so what we do is say, I don't want AI to do that. I want AI to churn through the numbers and create the analysis that we then look at and say, okay, here's this one set of information. If I ask AI, if I have my tools give it to me 20 times, it's going to give it to me the exact same way. But what it is going to do is it's going to say, okay, you want to look at earnings. Large earnings, small earnings. You want to look at them by sector or by index, U.S., non-U.S., over time or in the current quarter, what's expected or what's already happened. And that AI is brilliant, and that's a lot of what we do and what we're using it for.
That's great, Jim.
I'm sure there's a lot of time savings there, right? I mean, part of it is just the efficiency gain, right? Saving time versus doing it all yourself. Is that kind of how you see it, or are you just trying to get additional perspective?
So we do something different, Jim, which is in the way that the investment management, the business we're in, which is to provide investment research. The way that it's done in general is you have one view. S&P earnings are strong. But what happens if I'm meeting with a client who's invested in a small cap value fund? The reason earnings are great is because they're looking at large cap semiconductors, or if you're running a Europe fund, or if you're in private credit. So what we're doing is we're not saving time. We're doing work that would have just been uneconomic before. So what we're doing is when we're sitting down with a client, we're actually saying is, okay, you're invested in a portfolio that looks like X, or whatever that X might be. What's going on in your portfolio? So when we say earnings look strong, what I'm really saying is the earnings of the companies that you hold today look strong. And that may be weaker or stronger than other peers. So for example, we do a lot of work, for example, if you're running, let's say, a mid-value fund or an industrial hedge fund pod book or something. How does that look different than other people who are doing things exactly as you are? Are your bets lining up the same way? Are the risks the same risks that you've taken, or are you changing your stripes for some reason? And then when the conversation happens, your portfolio looks a certain way, but that seems pretty at odds with the way that you've normally managed money. What's interesting? What's making you think about it? And they may say, well, the reason is because maybe the driver of industrial activity is the build out of data centers, or maybe it's the war in the Middle East and in Ukraine are changing our view on aerospace and defense. I mean, or that you need to build out the national energy infrastructure as a result of data centers, and so there might be very good reasons, but very often they're saying, am I really doing something different? Or it's really surprising. I would have thought my peers would have seen exactly what I saw. And so AI is giving us tools to do that work. I like to think about it as research for one. When I'm talking to an investor, I want them to feel like they're the only pretty girl in the room. It is all about them, and as opposed to something which is big and broad and generic, which may be insightful, but isn't as specific to that individual.
So you're
It's more personalized.
Yeah, you're
100%.
creating,
Yeah.
you're leveraging AI, you're scaling, that's the word, and you're having targeted discussions and you're speaking to each individual client. I like that. It makes sense.
Well, yeah, I mean, you asked a question before, why Seaport? I've spent my career at these world-class, not saying Seaport's not world-class, but at JP Morgan, at UBS and Credit Suisse and these household names. But what they generally want from a strategist is, what's your market target? What are your favorite sector calls? What do you think of regions? And over the weekend, we ran 4,000 separate analyses on 4,000 separate client portfolios, and then are presenting it to them uniquely for them. That's not necessarily the way things are done. And Seaport really bought into this vision of this client first, one-off customized work, and it's really special.
Can I ask about the business? So is it just pure independent sell side research, or is there trading and the typical sell side stuff that you see?
Yes. So let me step back. So Seaport Global, who's our parent company, is the largest privately held credit trading shop in the world. So these guys are like the king of bonds, and they started a number of years ago an equity research boutique where it was every one of the research analysts is kind of independent. It's their own little franchise, if you will, and they're all very, very senior. So these are people who've been doing this on average for 25 years, and it's their slice. So there's no desire to say, wait a second, you need to line up your views with somebody else. You're getting the very best of what they're thinking, and their access to corporate management and the like. And they're at over 30 research analysts. And so it's probably the most formidable research shop on Wall Street that many haven't heard of. And it's been a home run. And by the way, this is an aside, it's the fastest growing research shop on Wall Street, partially because it empowers the analysts to do what they love doing. There's no investment banking. There is no trading. So if somebody, and I know that you didn't ask this, but if somebody wants to pay us, they can pay us in trades. They can pay us in a hard dollar check. I mean, we do have a real trading desk. We have a derivatives desk. We have a special situations desk. So it's a real firm with real capacity, but it is first and foremost, it is all about research, as opposed to this being a stepchild to investment banking or something.
Well, that's important. So
Sure.
For advisors who are watching and listening and don't appreciate that, there's no apparent conflict of interest, right? And that's kind of the right. So I mean, that speaks volumes right there. But I wanted to pivot here to something that I and Jim spend a lot of time thinking about in our outlooks and our mid years every year. This gets to the forecast and the targets that you mentioned. But let's take a step. Having done that, let's kind of take a step back and think about the bigger picture and where we can go. But when you're setting about a target for an index, pick one. It doesn't really matter what it is, but conceptually, what are the variables? I kind of know what you're going to say, but I want to hear you say it. What are the variables that matter the most to you, and how much of that comes from, for example, earnings versus valuations?
I mean, you kind of just hit the punchline, but it's anybody who predicts the direction of markets for an index or a sector, whatever. You have to start with that. There's two separate things that you're trying to predict, which is what's the PE and what's the E. And in both cases, it's the forward PE and the forward earnings number. And then on each of those, you need to break down what are the things that drive earnings and what are the things that drive the stock multiples. So if you take a look this year, it's very interesting. The market's up, I don't know what, 12% or something like that year to date. Well, as of this recording, and the earnings are up way more than that, and the valuations are down. So what most of the narrative that we're hearing in the financial press is stocks look very expensive because they're up so much. And I'm like, no, stocks are cheaper because the earnings are going up less than the prices. And so that's the starting point. And then the question is, well, why would that happen? And then you say, okay, well, these are discounted cash flows. The cost of capital is the single biggest driver, all else being equal. And so the 10-year bond yield is up 60, 70 basis points this year. And that is a big problem for discounting cash flows. Now, if you look at that and then think about how that is absorbed by the market, because the AI world is a new world, and these companies, especially in hyperscalers and data centers, these investments are not investments that are necessarily going to win today. These are investments that are going to win for the next 10 or 15 years. The equity duration has just extended and got longer. So what does that mean? Think about a bond. If a bond has a longer duration, it's more sensitive to rising rates. So if rates are rising and the equity duration on tech moved out, then tech should naturally get more beaten up by these rising interest rates than normal. So one of the things we have models and you have models, and I'm not sure whether your models are better than my models, but the thing is that the world isn't static and anybody can run a regression. The question is, why does it work the way that it does? So I'll give you an example. I mean, this year, credit spreads are relatively unchanged. The market is 5 times more sensitive to credit spreads than the 10-year bond yield. So normally I would say that the 10-year bond yield is up, but the credit spreads are fine. So maybe valuation shouldn't be a problem, but it is. So you really have to understand what's going on in a moment in time. The same thing, if you were forecasting the earnings and you were using, and this is kind of the way I cut my teeth in the business, you start with, well, what do you think of GDP and what do you think of inflation and the economics? The economics would tell you that earnings should be up, 10% this year. And interestingly, if you look at the average or typical company in the S&P, it is up 10%. But with the tech landscape being so important and with energy prices being up because of the war in the Middle East, the earnings are off the charts. And if you simply said, oh, my model says do it this way, you would have missed the whole picture. Mm.
So one of the biggest drivers and themes, at least for me and my macro micro work, has been margin expansion. And I think that has been underappreciated by many in the marketplace. And so really for us and our overall outlook, it's really been earnings that's the dominant driver. But I wanted to ask you from your lens, like, what are you seeing? Do you think investors, we'll say maybe the media, are they overestimating the macro risks and underestimating the earnings power here?
It depends on who you are. I think people who are professional asset allocators tend to spend way more time thinking about the macro and not really appreciating. I mean, here's the bottom line on all of this. We are experiencing, and I would say for guys who have a little bit of gray in their hair, or maybe some guys who have less hair, this will be the best earnings season in our entire careers.
Almost 50%.
Almost 50%.
Yeah.
And why is that the case? It's not just random. We are experiencing a capital expenditure boom that is nothing like we've experienced in our careers. It's way bigger than when in the early O's or the late 90s with the internet or the building out of all this cable under the ground. Mm-hmm. This is much bigger. It's almost like what we did when we built out the railroads or the car industry, but instead of doing it over 40 years, we're doing it over 3 years. And so it's not only driving the tech names, it's driving the industrial sector. You have to You have to heat, so you have to cool these data
Cool
centers.
them off. Yeah.
You have to build roads to get to the data centers. You need to build electricity capacity, and that has a whole bunch of things. And then when these stocks go up, you get the consumer has a wealth effect, and they're spending money, and so it's really a virtuous cycle. And the banks have to finance all this and lend to them and do capital raises. So there's something very special going on. And Tal, you and I were talking about this yesterday. It is always worth saying, okay, but what can go wrong? And not because you're bearish, but because we're paid as fiduciaries to worry for our clients, to think about what could. But when you step back from it, and we could spend as much time talking about but what could go wrong. This is truly extraordinary. And in reality, the analyst community, the people who are predicting stocks earnings and stock prices, are underestimating this power, which is why the estimates keep getting adjusted higher. And the asset allocators keep underestimating because they assume the most powerful thing in asset allocation is reversion to the long-term trend. Well, if you're in a multi-year period where things are wildly away from the trend, then you just keep betting against equities, keep betting against the US, you keep betting against technology, and you just leave too much money on the table.
So, Jonathan, I got a question just to kind of follow. I love where you're going with this, and I agree with you. These types of environments sometimes also create pockets of froth or pockets of, speculation, meme stocks, and some of that may be a little bit warranted because of supply demand equilibrium, especially as it relates to memory stocks. But what do you think? Do you think that these things just stay isolated? And then the other thing I've been hearing more about is the single stock 2 times, 3 times levered ETFs that are they're not diversified. It's just leverage. So, and I don't know how much of that leverage is feeding some of these parabolic moves, but what do you think of it? My personal view is that these things stay isolated, but I'm curious kind of, what your thoughts are and what your analysts think about some of these things.
So my clients are institutional investors, and there is a class of companies that are speculative in nature. And if I said what is the ultimate speculative asset? It would be Bitcoin. We don't use it in our day to day. It doesn't make us full when we're hungry. It doesn't make us less thirsty. It doesn't. Sure. It doesn't warm our home. If somebody can explain what it actually does, other than being an asset in its own right, but the value of it is whatever we assign to it. There is no underlying cash flow. If you buy a treasury security, the federal government has made an obligation to pay you a certain amount of money on a schedule. Now, they could default on that, but they probably won't.
Sure.
If you were buying shares of whether it be Disney or McDonald's or whatever it is, they're going to sell hamburgers. They're going to sell ads on ESPN or admission to a theme park, and you're going to have a share or a stake in that. If you're buying a unit of Bitcoin, there's no underlying cash flow or obligation that somebody's. Now, I'm not saying that it's not going to go up or down, and that's beyond my ability to think through this. There are companies that trade on a whim, not on the underlying fundamentals. And I'll give you an example because one just recently came to market and one is a sister company. But if you look at, let's say, the average company in the S&P is right now trading at about 19.5 times next year's earnings. We can argue whether it's a little high or low, but that's about a half a standard deviation above normal. It's pretty darn reasonable. If you look at Elon Musk's companies, they're trading at multiples that are a couple hundred times or more. And those are, we can argue whether they are the future. We can argue whether SpaceX will change the way that we live our lives, or the way that Tesla will change the way that we drive and live, in robotics and data centers and all these wonderful, cool things, which I'm not going to question. But the question an institutional investor asks is, what should I pay for a unit of their cash flows? What should I pay for a unit of their earnings? And therefore, when those numbers decouple from each other, they tend to not be held by my client base. That doesn't mean now. So what if you think about it, there are shares in the marketplace, and if they're not held by a typical institution, well, that means they're largely being held by the public. They're being held by somebody who's doing their own stock picking, and they love the story, and they buy the stock, and they don't have the framework and the tools that the three of us use every day. Now, that does not mean that those are not going to go up or more or less in the market, but it does mean that they don't tend to fit into the frameworks that the three of us naturally use. Now, they're not the only ones. I think that you're going to find that some of these other AI-related names, as they come public, are also probably going to trade on no earnings and infinite multiples. And that they will, by and large, be held also by the public, not by institutional investors. Again, it's not an indictment of the companies or what they bring to society.
Sure. Jonathan, how about those companies that sell side widely follows them? They could be like a modular nuclear company, but sell side widely follows them, but like they're not going to be making any money anytime soon. Is that still primarily a discounted cash flow, but we're going to go way out and see where they make money and then try to say price today should be this?
Jim, it's not where I spend most of my time, but let's just dig into this issue of non-earners.
Yeah.
In the small cap index, which is the Russell 2000, something in the ballpark of 35 or 40% of the companies don't
make any profits.
They're not profitable. And in a perfect world, you would say these really probably belong in the venture capital space. So if you take a look at those, something in the zip code of 50% are biotech companies. So let's assume for a second that we have a friend who we went to college with, who's was a scientist, and he comes up with some molecule that does something to the brain, and maybe it's going to cure Alzheimer's, and it's going to take 5 years. What normally you would do is you go raise money in the private markets, and when you have a drug, you take it public or you sell the company. A lot of these companies have said, why don't we just take the company public now? There's no profits. The market will put a number value on what they think the future potential is. But that company, if they actually find that it passed these drug tests and is going to go to market, they probably will sell it to a big pharma company, because that scientist and a bunch of his colleagues, they don't really have the ability to distribute it and go through all the trials and manufacturing. So they probably never have an intention of having this be a profitable company. It will forever be, and it's almost like a binary outcome. Yes, they're going to be a winner, or no, they're going to be a loser. And between now and if they're a loser, they go to zero. And if they're a winner, they become they become infinitely valuable, and everybody talks about them. And so, but there's a lot of these companies, they don't tend to be in the larger cap space. They really are in small cap, and it's a whole different world in that sphere.
Interesting.
Let me change it up a little bit. So we're all chartists. And as I see, this got me thinking, all of our backgrounds, we've got pictures on the wall. What's the one chart, Jonathan, that you would tell an advisor that it's a must-have, that they should have hanging on their wall? It's kind of a two-parter. And what's the first thing that you look at when you get into the office every day?
So this is not what I would tell an advisor, and what I would and what's most important to me. They might be a little bit different, but if you look at stock market returns, there's this general belief that markets return something in the ballpark of 8 to 10% a year over the long run. I remember that when and I'm an old guy, but when I got out of college, and it was in the if I must say in the 1980s, and my father had been a stock investor throughout the late 60s and 70s and into the 80s, and for 15, 20 years he had about a zero return. He got a dividend, but he didn't get there's no capital appreciation. And his advice to me was put all your money in a CD because at least you get a guaranteed bank return because stocks are a zero returning asset. And then, probably almost the minute that he said that, the market ran from the early 80s all the way till about 99. And if you go back in time, if you went before like I think it was 66 that this flat period started, and you did the 10 to 20 years before that, it also gave you double returns. And then if you went before that, you got flat returns. If you looked in the period the Great Depression and World War II. And so I think that investments operate in regimes. And so when you tell somebody that, yeah, 8 to 10% is what you can expect the rest of your life, that's true if they live 100 years. But it's very possible that stocks give you nothing for the next decade or give you 25 a year for the next decade. And you can't average those two things and say, well, that's 12. And the same thing with inflation and the same thing with interest rates. And so, I mean, I look at interest rates, and if you did this again, a longer term chart, rates, I think that given that we're running roughly $1 trillion is the amount of interest that we're paying on our debt right now. We're running in what looks like a healthy economy, just unbelievable 6-7% deficits. That it's very possible that we're going to be moving into a much higher rate environment for quite a number of years. And if you simply take a regression and say, what does the average look like? You wouldn't come up with those conclusions. And so when you think about, when people think about their wealth, it's very easy to say the guy who went all in on stocks, and by the way, I'm a pretty bullish guy, and I've been largely all in on stocks for the majority of my career. But what I do know is that during recessions, stocks give up a huge amount. And there's reason to be cautious when things look like they might become unwound. And so that would be, and there's a whole bunch of, you guys probably have 5 times more charts that make this point than I do. But that would be the most important thing. If you said to me, what do I care about? Like, what do I look at every day and obsess? Stocks move not because things are good. They move because things are getting better or getting worse. Right. The best environment is when things are lousy and turning up. And by the way, good and getting faster is also great. But the best environment is bad and getting better. And so rate of change, that second derivative that guys in the business talk about, is where all the story is. And high growth rates are not that important. They're not important for the economy. They're not important for stocks. It's improvement, it's acceleration or deceleration that drives everything.
It's interesting. We kind of do something similar. We look at trend reversals, right? So one of the factors we use, we have a quantitative multi-factor quant-driven model. It's still actively managed, but we look at the 4 factors that most people are familiar with, quality, momentum, value, low volatility. We had trend in there. Sometimes, not always, but sometimes trend is so bad and then it starts turning around. Sometimes we find there's also value there. The momentum is not quite there yet because they just turn, but the valuation is good. The earnings are, as you say, getting better. Sometimes those turn out to be good investments because people generally hate it.
No, I mean, listen, I was talking to somebody who runs the a tech pod at one of the top 3 hedge funds. And we were talking about the AI related semiconductors, Avago and Nvidia and Micron and some of these others. And I'm pretty bullish on these names. I think that they're going to surprise the upside over multiple years. And he was saying, John, I'm short. I'm short this pack. And he said, and I'm like, why? And I'm laying out the case. He says, first of all, everything you're telling me is well known and well understood. And he said, the second is, can they grow it faster? Is the incremental growth up or down?
Yeah.
And his feeling is that if the incremental growth is down, there's a lot of quantitative hedge funds that start to trade on that rate of change. And so if you're growing at 60, the question isn't whether 60 is good. Is 60 going to 50 or 60 going to 70?
Yeah.
And his math was that 60 is going to 50, and he's short the group. Now, by the way, he's looking insanely brilliant over the last 6 to 7 weeks.
Right.
I still like my story.
Sure.
I still think he's going to lose money, but right now he's much smarter than I am.
Interesting. Well, and we try to own both of those. I mean, because I don't have a crystal ball. Some of these you have to look at and underwrite it based on what information we have. Is Nvidia's margin going to expand or is it going to contract? But I just know that there's still a lot of demand and there's still a lot of capex. But yeah, that's super hard. I feel like to predict if margins are going to go 75 to 80 or 75 to 60.
So Jim, I think this one's an easy one to get. Nvidia's margins are going to have to come down.
Yeah.
I don't know whether it's 6 weeks, here's the question, which I don't know. If they still are insanely strong, does the market ultimately does it end up being a good stock? And my take is, I think that these companies will go from by far the highest margins to still way above average margins.
Yeah.
And they'll be good stocks anyway.
That's true.
But here's the thing, that's where the debate should be. I think that there's less of a debate that trees don't grow to the sky, but they don't lose their leaves when they stop growing. When they stop growing, they can live hundreds of years at the same height and still flourish. And so that's where I think the debate is, and that's more difficult.
Do you think that in some cases they're punished maybe too much, maybe the media or maybe retail investors or institutional? I mean, there was a point where Nvidia was actually cheaper than the market, and I mean, the margins aren't 10%; they're still 70, 75.
Yeah, no, I mean, listen, I think that this group is if you take a look at if you look at, let's say, and I don't want to say the older cohort of tech mega caps, so the Apples and the Microsofts and the Amazon, sure. and then you look at their growth and their multiple, and then look at the AI related semiconductors, and we'll just say Avago and Nvidia.
Yeah,
the semiconductor names are growing the earnings 3 times faster for roughly the same stock multiple. And so I do think the semis names are a win. And Micron, we know that Micron is trading at a huge discount to the market.
Sure.
Partially because the market says there's no way that we're going to have a memory shortage forever, but we can have a memory shortage way into 27.
Yeah.
So there's a large discount on a lot of these kind of companies.
Interesting.
It occurs to me that what we're kind of talking around here is different time horizons and holding periods, right? And so I think that's partially the explanation for what can make a good company a bad stock, because the trade just gets overcrowded, and that was the case with the semi-momentum trade. But the pendulum swings pretty dramatically in both directions, and when I think we're kind of saying the same thing here. When the fundamentals are as healthy as they are, and we don't really see a reason for them to change, at some point the sentiment and positioning gets lopsided in the other direction.
There's a great, I I'm a big fan. I'm gonna divert the conversation a little bit, but I'm a huge fan of Milton, the late Milton Friedman, and for those that haven't watched his videos, they're great to read, and if those who haven't read Free to Choose, it's great. But he talks about when people talk about, well, the market moves between fear and greed, and Milton says, Talley, are you greedy? Like the other person's greedy. None of us. Jim's definitely not greedy. It's some stranger. And if Jim were greedy in the past, he's definitely not greedy today. I think from where I sit, I try to distill the market down into things which are unequivocal, can't be debated. I know what the market's projecting on cash flows. I know that the market continues to increase the estimates for tech companies and for companies in general, which means I know that there's something going on, that the analysts are systematically underestimating the power of these trades. It appears if you flip a coin 30 times and it comes up 30 heads, it might be a normal coin, but it probably isn't. If the analysts every month keep adjusting their numbers higher on these names, the issue is probably not the general environment. It is there's a bias that the analysts have that they're unwilling to buy into this new future that's being laid out. So when it appears like sentiment is moving towards an extreme, everybody's getting in these names, I try to basically say it's like fear and greed. We're all greedy and we're all fearful. What are the numbers? Show me the numbers. And I try to literally turn that dial down on sentiment and you said it the exact right way. If I were looking at this as a 6-week or 8-week trade, I would be focused on nothing but sentiment. If I'm looking at this as a 1 to 3 year trade, I want to basically say, turn off sentiment entirely and only look at underlying value of what are the underlying cash flows and what is the discount rate. So let's go lean into that. You asked the first question about predicting markets and interest rates and cash flows. I think that the 10-year bond yield is going to go up, and I think that interest rates. And I think that the earnings are going to also surprise to the upside. I think that what we've seen this year, which is good returns on extremely good earnings, but multiples declining, I think that's going to be the story in the next couple of years. And it will confuse the heck out of people because the market will look cheaper and cheaper and it'll still go up. And and people will have this debate. I think we're going to be having this debate for a couple of years.
Interesting. Do you think the interest rates are going to primarily go up just because of the deficit and the spending and like policies just too loose, or is it there's going to be some inflation in there? Because that's been kind of all over the map too. We have high inflation, then it came down, and then there's the war and oil prices. But
so I think there's a number of things. First of all, I'm not a believer that we may get a ceasefire. And as we're talking, there's been, it's in the headlines, but I'm not of the belief that this is going to quickly come to a resolution, which means that oil will contribute not only to the headline, but even the core inflation.
Sure.
Because things like roofing material goes up, or the cost of the asphalt that you use for your driveway, or because they're based on petroleum products. We also we're not bringing labor into the country, and the economy is running really strong. The unemployment rate has fallen for 7 months. The number of people getting fired keeps falling. And so there's very, very strong labor demand. Ultimately, that pushes inflation.
Wage prices go higher. Interesting.
100%. And then on top of that, I mean, if you look at the debate right now on, the intervention in the Japanese yen market, why do we care about the Japanese yen? Why is it such a big issue? The reason is simply Japan's the biggest holder of treasuries. The easiest way for Japan to get the yen higher would be to sell their treasuries. Um, we that would really be very, very problematic for our states. And but here's the question, even more so, why this matters so much? Because we are trying to finance multiple trillions of dollars of infrastructure for this AI thing, and for people who have money in their pocket, they have choices on how to invest it. They invest in the stock market. Do they put it into an AI project and buy debt of one of these not money centers, one of the these data centers? Do they they lend money to the government through bond purchase? And if we're finding that the government needs more and more to finance itself, and there's demand for this insatiable appetite related to AI, excess demand for capital, what does it do? It pushes rates higher. The rate, I'll tell you what rates are not going higher, because it's not going higher because there's concern that people are going to default on their debt and they need a higher premium. It's just the demand is unbelievable, which is a good thing, but it does mean this dynamic is really important, and one that we're going to be talking about for a while.
Interesting.
All right.
Let me ask you guys, if I could.
Yeah, do it.
Your clients are different than mine, and the one thing when you're talking to not only advisors but people who advise the public, I think it's always you may have the end client may not be an economist or a strategist or a CIO. He may own 3 or 4 dry cleaners, but he does understand when customers are coming to the door to his business more than they did last week or less. He does know if he can't get people to work in his business, or the costs of the product he sells are going up, and he can't and he can't pass it on to customers. So these people, while we sometimes think that they're less sophisticated, the big difference between them and us is that we have a fancier language than they do in the way we describe it. What's their level of optimism or pessimism? What are the things that keep them up at night as they're making when they're talking about decisions they make on how to pass their wealth to their children or to plan for retirement? What's the debate like in that audience? Because I tend to not talk to those. I tend to talk to a slightly different audience than you.
Well, I'll go first. So our clients are our advisors, but we do, Jim and I and the investment strategy committee, we do help them by running models it's kind of like an institutional style money management process. So in that respect, we do from time to time end up engaging the end customer, the Mr. and Mrs. Jones, basically our moms and our dads, right? But I think to answer your question, it really depends on where they live in the country. So, and you have to wear your different hats, but we have a lot of clients on the West Coast, and as you can imagine, given our current political state of affairs, they think the world's ending, and so they're very surprised when our advisors are able to show them the good returns that we're generating. And so this is, we have that typical conversation. These are the major bricks in the wall of worry that the market likes to climb, and your money's in good hands. But how would you round out that answer, Jim?
Yeah, no, I think that's a fair point. And, again, we have clients all over the place. So there's clients in the South, there's clients in the, Northwest and Southwest. I think some of it comes down to demographics, what their needs are. There's some of them that are, aging and need more income. Some of the conversations I've had with advisors tell me that, they're concerned about taxes, right? Everyone's concerned about taxes, I guess, especially in California, concerned about taxes there. It's a strange environment to have the market near all-time highs and money market account balances are near $8 trillion, and consumer sentiment is like near the lowest it's ever been. And so some advisors I've talked to said their clients they're happy with the returns, but they're not they're not happy about some other things. And so some of that may be political. Some of it may be, their children, who graduated college can't afford to buy a home, right? So there's different things that are going down, and then there's others that, maybe they haven't had as much business because they're concerned about types of people that frequent their business. So it's just, yeah, it's interesting. And then there's people that work in AI, and there's volatility there, and opportunity. And so it's fascinating. I'm sure we could probably come up with, hundreds of stories of different clients and who are experiencing different things, but, they're all participating in the market, and in most cases they've done well, but
I think it's also interesting. Yeah, I mean, you raise a good point. We project our own personal experiences and our own viewpoints on the market. So if you're someone who loves the president, you probably say, "See, I told you. Look how great the market is." And if someone doesn't love the president, they look at policy decisions and say, "Yeah, this may be up, but this thing is very precarious." In both situations, I don't think that there's a full realization that the average consumer, the typical small companies, are really not represented in the market, and so tech is represented, heavy industry is represented, banks are represented, and the high end consumer is represented.
Yeah.
But the low-end consumer is not. So if somebody says, well, here's consumer data that says whatever, and the consumer, I think, is actually generally fine. But my natural thought is I don't want to be callous and say I don't care, because I do care. I care as an American. I care as a human being. I care about someone who cares about my neighbors. But if as an investor, that median, lower half consumer has almost no weight in the S&P, and therefore, and so we were talking before about who's making good decisions right now. Asset allocators who very often overemphasize some of these issues on consumer confidence and the like, because you're asking the average consumer, how you feeling?
Yeah.
The average consumer is doesn't really have is not part of the bucket of companies. And therefore they tend to, it leads to a bit of a misread on what's going on. And again, I don't want to say I don't, because I sincerely do, but it's, but not professionally as we're looking at the market dynamics.
So Jonathan, this is a launch pad for, a discussion, and maybe we can land the plane on this one. But basically, the principles of sound investing. And there's that famous Templeton quote, and like you set it up beautifully, Jonathan, bull markets are born in despair. And this is a little quantity that I've written about, but the 12-month forward returns on the S&P from these absolutely bombed out, historically negative consumer sentiment readings are double digits. And so this is the kind of conversation that we always have, and the hand holding that the best time to invest is when you won't want to, and it feels awful, right? And so this is the stuff that I think helps us really kind of move the needle and move the money and put money to work in markets. And it's just the training and the discipline that helps us do that.
I'm going to describe this a little bit differently. Very often, when I did the CFA a million years ago, there was a bunch of articles on contrarian investing. When everybody's on one side of the boat, you want to be on the other side of the boat, right? And that was the argument. On the other hand, there are times where the pack is right.
Yeah.
We are experiencing something, and I think maybe we'll start where we begin. Is we're experiencing something that is unlike anything else we've ever experienced. And looking at it and saying, reversion to the mean, it's possible that we've just experienced an insanely good last 18 months of returns, and it'll be followed by another 18 months of insanely positive returns. because I mean, according Bloomberg puts out a survey of economists, and their recession odds just went from 25% to 20%. The Chicago Fed has a financial conditions index, which basically says are financial conditions, the things which are, is the blood that pumps its way through our economy, is that pumping well? And the answer is not only is it good and better than almost ever, it's getting better. And so there's a lot to celebrate, and so it's interesting. So it's easy. The easy decision for the three of us is when it's bombed out and you're just seeing that it's beginning to inflect. Then the only fight is how do we get our clients to play along. Yeah. Right now, the question and this is a question for you is the question to say to your clients, guys, this is something. There's something really special. Don't get too cute and get out too early. I don't know. We'll know in 5 years from now. But my inclination is that is that you do want to stay bullish on this. There is something special going on, and it doesn't mean it's going to be a straight line, and it doesn't mean that there's not going to be that one or two of these companies isn't going to survive it. But that doesn't mean that this isn't something really special. I don't know.
I mean, I'm sensing an Animal House quote in here somewhere. I read about that one too. Over?
No,
you say over?
What was the Animal House quote?
You know the Bluto, the quote over. It was the inspirational speech. Did you see over? Was it over when the Germans bombed Pearl Harbor? It's like wildly inaccurate historical statements.
Yes.
But yeah, no, I mean, I want Jim to get in here too. But when I look at my positioning indicator, I'd say we're neutral, and it's far too soon. You asked me if I'm greedy or fearful. I'm still bullish because I think the strategic sentiment pendulum is still kind of in the middle. We haven't swung to ebullience yet in my at least from my lens. But what do you think, Jim? What would you say?
Yeah, no, I would agree. I mean, I would worry when everything starts looking the same, the charts start looking the same, taxi and Uber drivers start giving out plenty of stock tips, and everything becomes parabolic. That is probably for me the more worrisome time. I don't think we're there yet. There's always going to be some meme stocks that are out there. I do like the breadth. I do like more companies are participating. I think that's really good for the market. It's not just a handful of names. It's, lots of companies benefiting. And I think to the degree that more and more companies are benefactors from AI development, AI investment, they can, their margins can then increase if they're using it the right way. Of course, the large AI companies are going to continue to benefit from that. So I think that's interesting. I guess one final question for you, Jonathan. Your work and your research that is quantitative, that is looking at factors and styles, has to, this question has to do with how things are sliced and diced. You've got a lot of money going into indices almost indiscriminately. A lot of people that are participating in 401ks, but a lot of money going into different factors and styles. You have, I feel like in some cases, unintended consequences where you get Micron being a 19% holding in the value ETF, right? And I know how MSCI kind of designs these things, but then you've got you've got value companies that feel more like growth companies that are in the value index. And then there's growth companies, or there's value companies within growth. Do you think that at some point we need to relook at some of these things? And even within technology, do you think we should because technology is really part of almost every part of our lives. should we look at changing how we classify these things, or what do you think?
Well, I mean, so and by the way, you're asking a question now that we could probably talk about for 2 hours.
Sorry.
But, but I mean, if you look at the global market, I think it's something like 72% US. And so for all of the conversation we've had with people about diversifying globally, we're in a US world. And if you look at the part of the world that's the most interesting that's not the US, it is the tech sector in Asia and places like Korea and Taiwan, which behave kind of just like the US. And their correlations are like the US. They're like the TSMCs and the Samsungs and some of these other stocks. So and then if you look at the S&P, what we define, we call a tech star, is if you add officially, for example, Google is communications and Amazon is retail. But if you ran a tech fund, you would say, yeah, those are tech companies. I can put them in there. We're just shy of 50%, about 45% in tech. But if you look at all the businesses that are engaged in things that feed the AI and technology beast, so companies that make that help build power plants to build out our energy capacity to power the AI stuff, or other things like that, you're looking at a market that's really 65% in the U.S. a tech story. Wow. And so that's just the world we're in.
Sure.
And so if you then look at the other pieces, they're just naturally smaller. I was just looking yesterday at the allocation globally, and so the U.S. is this huge chunk, and then you go to the second country, and it's like 5%, and very quickly you're at 1%. Like there is no rest of the game. So it's really hard to tell your clients to diversify within equities when they could diversify as long as they're massively overweight U.S. tech. And then so you're talking about, you can buy a couple of healthcare names and a couple of consumer names, a couple of industrials, but at the end of the day, your returns are going to be driven by one thing. And if you happen to have some concern about rising interest rates, and then you have that means that diversifying out in bonds over equities becomes also more difficult. It's a hard game to advise. When we started this whole index business, and where we're looking back, really it started with ERISA, which I think it was the 70s.
Yeah.
We said, all right, we're going to break the equity markets into these separate buckets: large, small, growth, value, U.S., non-U.S., and we're going to put a little in each, and therefore we're going to be diversified. And in reality, the whole thing is just kind of coalesced around large cap growth, and everything else has become much less consequential. Not necessarily bad.
Yeah.
And by the way, if you fought the trend, you underperformed.
Oh, 100%. Yeah, that's true. Interesting.
So the moral of the story, I think, is read the label, know what you own, and understand why you own it. And we made the point recently, Jonathan, that some investors, they bought emerging markets, good growth, must be diversified, right? Actually, no, it's 2 or 3 South Korean.
No, and they look just like the U.S. No. So, all right, so here are the takeaways. Number one, don't dollar cost average. If you're going to do a jump in, you're going to, over the long run, it's a better strategy. Number two, diversifying outside of the U.S. Unless you think the U.S. is going to be a weaker economy than Europe with less technological innovation, maybe you kind of continue to be concentrated and just make sure that you're planning properly for your future. I don't know, but the advice of being diversified probably was a costly one. That doesn't mean it wasn't worth doing, right?
Sure.
You don't know what outcomes are going to be. And hedging and not having, listen, we take out life insurance, not because we want to die. And you don't say, darn, I paid for that life insurance.
I didn't die.
I wish I would have died. So we diversify because things may not turn out the way that we
Yeah.
expect. But boy, in the last 20 years, it's been a concentrated story.
Well, we'll agreed, and we'll have to leave it there, Jonathan. But so easy, and look at us. We filled an hour, no problem. We'll have to have you back on the show again sometime.
Excellent. I look forward to it. This is
Thank
really
you.
fun.
Thank you so much for joining us, John. This has been a great conversation.
Hers and his, three's company too. Come and dance on our floor.